Hello, good evening, everybody. Good evening.
Good
Can you
evening.
guys hear me? Yeah.
Good evening.
Okay, we're going to start now. For those of you, I know you guys don't know me. My name is Edward. Okay. So I'm a forex trader. I'm full-time forex trader. Okay. I'm a price action trader. I also deal with robot and other stuff, technical, but I'm focused on technical trading only. Okay, which means you need to like focus on the charts. I know about fundamental sentiment, all those are types of market analysis. Okay, you get to know all that. But first of all, if you look at my screen, what you are seeing here right now, you see the question. This is the question mark. Do you want to be rich, be comfortable, and be secure? I believe that every one of us, the response to this question is yes. And if you look at the one that I highlighted in red, it says time is the price you have to pay. Okay. And also, please, I know I talk a little bit faster, so you can look at the screen, okay? But I will try as much to slow down and understand me very well, okay? The next slide, so you are welcome. I already introduced myself already. My name is Edward. I'm a forex trader, and I've been in business for like 6 years. I was introduced to Forex in 2014. Then later I came back again, like around 2016 to continue. And from there up to now, I've been trading. And at least I can tell you that it pays my bills. So I do trading full time and also understand that the market, you make money. But if you don't understand what you are doing, you will lose money. So that is why you need to get the skills, because acquiring the skills is one of the most important aspects that you guys need to know. Now, one thing you need right mindset approach and risk appetite. Okay. The reason why I'm starting like this is to help you guys to understand the type of mindset that you need. I know some of you guys, you might have heard that, oh, Forex, you can make a lot of money. But I'm beginning in a way that your mindset should be on the right track, so that you don't suffer like many of us that will pass through long process, paying so much money before we get to where we are today. So you have to pay attention to what I'm going to tell you now. Now, getting rich is automatic only if you have the right formula. Note this statement. Now, say the power of compound interest and how it can make you rich. Say most great fortunes are built slowly. They are based on the principle of compound interest, what Albert Einstein called the greatest power in the universe. Brian Tracy. This is a quote from Brian Tracy. Then look at this graph you can see on my screen here. I use this scenario a lot in my projection. So who will earn more? There are two people here. We have the investor one, investor two. The guy on investor one started at the age of 25 years, setting aside $5,000 a year in 10 years in a row. No more investment after the age of 34. Then the other guy started at the age of 35 years, investing $5,000 each year for 30 years in a row until reaching the age of 65. Now look at the return when they got to the age of 65. The investor one, which started at the age of 25 years, made $787,000, 180. The other guy who started at the age of 35 years, have $611,730. Note, assume an 8% interest rate compounded annually. So balances that shows that approximate, okay? It tells you how, when you start earlier, the advantage of compound interest and how you can able to grow your capital. This is what these images are just explaining to you, okay? Now, risk warning. This is very important. So trading derivatives carries a high level of risk to your capital, and you should only trade with money you can afford to lose. Trading derivatives may not be suitable for all investors. So please ensure that you fully understand the risk involved and seek independent advice if necessary. If you go to every broker, you see this in their website. Every broker is there. Investment, everything is risky. Even life itself is risky. Nobody guarantees you that you can take a plane and go into US and you get there successfully. Everything is risky. But when it comes to trading, risk management is a key, okay? Now, this is an image. Like I said, I'm trying to get you guys, your mindset in the right track. Look at this image here. If you can see this image, please say yes. Let me know you guys are following up. Can you see this image?
Yes, we can see the image.
Okay, the first image here, you can see they talk about people in the school. Then you see the other one, they are workers going to work. Then you see the other one, Forex trading. No, this image simply explains there are a lot of messages behind this image. You spend 4 years in school, for example, let's say in university, then after that you go for master, you spend like 3 or 4 years depending on the course. Then you will now maybe spend like 1 year, or depending if you have connection to get good work, immediately are coming out of school, or you will spend time even to look for work, and until you get that, you have to work maybe like about 10 years, even let's say 25 years. There are a lot of people who have been working for 25 years in an office, and if you're not careful, maybe when you have any illness or anything, they can sack you, replace you. And at the end of the day, you even have less, even 200,000 or even $1 million in your account. Okay, but look at Forex. How many years are you willing to put into to learn the skills that's going to require you, that will pay you for the rest of your life? How many, the time, the commitment, what are you willing to put in the result that you're going to get? Okay, there are a lot of things behind this image, but this is just to help you to understand the psychology of what you are getting into, so you get it right. Now, introduction to Forex trading. History of Forex, okay? You know, the history of Forex, when it started, it was using barter trade. You guys, a lot of you know what is barter trade. When you use things to be able to exchange for that. Let's say for somebody who have, let's say you have a pen, you want to get something, you give your pen to the person to be able to get a book, or you have a kettle. No, it's just the exchange of using things to be able to get one another, to get something else, okay? But as time goes on, they also introduce gold. So no, they introduced a coin. So coin they used to do an exchange. But one of the disadvantages is that they are so heavy. Imagine if I'm giving you 1 million naira, or just I'm giving you $100,000 in a coin. It's going to be so much heavy to carry. Okay, but after the World War II in 1944, they introduced a way whereby we can able to accept the currency, which is paper money, to be able to do exchange. And Chinese are the people who invented paper money. Chinese are the people who invented paper money. And it became generally acceptable when the most of the top economic world came together, and they agreed by creating IMF, which is International Monetary Fund, to agree on currency. And everybody have to be guided by rules and regulations so that you don't print excess money. Because even during the gold period, when the money is being transacted to another country, you have to ensure that it's backed up by gold. And every country is guided in such a way that they don't print excess money. Okay? Now, when you hear the word Forex, it simply means foreign exchange. Foreign exchange, Forex, FS, whatever you call it. Trading two currencies without the basic knowledge is equal to gambling. That is where you rely on pure luck. You have to master the ABC, and you will already be better than majority of beginner trader. Okay, when you understand the concept, the ABCD of Forex, you will be able to make money in this market. Okay. Now, say Forex trading, also known as foreign exchange, is OTC market where individuals trade through online platform and brokers. The term Forex stands for foreign exchange. Forex trading, gives you a lot of time. You have time to be able to spend, to be able to trade. You choose your time to be able to trade. It gives you comfort, okay? But you have to exchange two different currencies against each other. Different currencies of different countries. Let's say Nigeria and Ghana, Nigeria and Benin, okay? So, for example, US dollar against the euro. The exchange difference is where you make profit or loss. So this point means that the difference between the exchange you are going to make between those two currencies, that is where you are going to make your loss or your profit. Okay? So there are major players in the market and phases. Before you trade in the forex market, you require experience in knowing how the market works. It is very profitable and also risky if you don't know what you are doing. According to the Bank of International Settlement, foreign exchange trading increased to an average $6.5 trillion in a day. To simply break this down, it means the average has to be 220 billion per hour. The foreign exchange market is largely made up of institutional investors, corporate, government, banks, as well as currency speculators. Roughly 90% of this volume is generated by currency speculators, capitalizing on intraday price movement, unlike the stock market and future market that are housed in a central physical exchanges. The foreign exchange market is over-the-counter market, which is OTC. Decentralized market completely has electronically. That is why you and I can able to have access to trade even on our phone, from our laptop. Though investors are familiar with the stock market, they are unaware how small volatilities in relation to the forex market. Forex market has a lot of volume when it comes to money. Okay. Now, forex market and other market, you can see forex trading by retail investors make up just 5%. What this means is that you and I just make up 5% trading volume of this market. So this means you need to understand and accept you are a little fish in a giant ocean, but that does not mean you cannot chase the big sharks and make money. But you need to understand that you cannot even move, you and I cannot move a market because we are just 5% of the trading volume of the market. Now, buying, going long, and selling, going short. One of the terms in Forex is that it involves buying and selling with one currency or the other. Okay, if you think the price of a currency will increase, you will want to buy it, which means go long. These are some of the terms that you will get to know. If you think the price value will decrease, then you will want to sell that currency, which means go short or down. Going long is easy. You buy the asset and sell it when its price rise. Going short is little more complex, but it's taken care of without you lifting finger. Basically, the broker or trading simulator will lend you the currency you want to sell. When the price falls, you pay the broker back at the lower price. The difference between the price that you borrow at the price that you pay back is your profit. As a forex trader, you'll be going simultaneously long and short as you trade the pair. For example, long Euro USD means that you buy euros and sell dollar. You will make money if the chart rises and lose money if it falls. It's best to try out how it works in the forex game with real-time market data. Okay, what this means is that when you believe that the pair is going to rise based on your analysis, which is what you are going to learn how to able to analyze the market before you buy. So when you buy, especially for example, for Euro USD, it means that you are buying euro and you are selling dollar. Okay, so the difference between the price, if it moves up, you are going to be in profit. If it moves down, you'll be in loss. Okay, now currency pairs. Currency pairs. Currency pairs is essentially a reflection of what the global market thinks the future of its economy would be compared to another country. For example, if you are buying British pounds against US dollar, which is GBP USD, you are basically betting for the British economy. In other words, you think the British economy will grow more rapidly compared to the United States. Afterwards, you just have to know how to read currency pair. We have the bulls versus the bears. Okay, while bulls are known for throwing an opponent in the air, bears tend to smash them down to the ground. This is an iconic analogy in the forex market. It represents rising and falling market. A bull market is a market that is rising in value. A bullish trader is one who believes the market will rise, thus go long. While a bear market is someone who believes that the market will go down. That is all the difference, okay? Then forex market participants. These are the participants in the forex market exchange. We have the central banks, we have the institutional investors, we have the companies, we have the commercial banks, we have the brokers, we have the individuals, where you and I belong, okay? So you get to learn more about all these participants in the market. These are the people that make up the market. So some forex terminology that you need to know as a beginner. One, currency. You have been hearing about the word currency. What is currency? The word currency traded on the forex market. But let's start with the very basic. What is currency? The word currency is derived from the Latin word currens, which means running or in circulation. A currency is money used as a medium of circulation, such as banknotes and coins. Some sources refer to currencies as a system of money used among people in a nation. The United Nations currently recognizes 180 currencies that are used in 195 countries across the world. Some examples of currency are the US dollar, the euro, the British pound, and the Japanese yen, which all act as a store of value and which are traded on the global foreign exchange market, which is Forex. Just like other assets, the forces of supply and demand determine the value of currency relative to another currency. Increase of supply of a currency sinks its value, while increased demand pushes its value. This is a very important point. So while this is the currency Euro USD, from this graph, from this image, you can see here, Euro USD is the base currency, while the USD is the quote currency. So the value of 1 unit of base currency into a quote currency, which is like 1 euro equals to $1.40. That's what it means. Okay. Now, currency pair. Even though currencies are traded on the forex market, we are not able to buy or sell single currencies. Each time we place a trade in the market, we have to trade on currency pairs. Currency pairs consist of two currencies. The first one is the base currency, which I explained, and the second order, and the second one, the counter currency. An example of a currency pair is Euro USD, which is the graph I just showed you. When we buy the Euro USD pair, we are actually buying the euro and selling the US dollar. Similarly, when we sell the Euro USD pair, we're actually selling the euro and buying the US dollar. Okay. Please, if I'm too fast, you can follow up. I put everything on the screen so that if you cannot follow my audio, you can simply just read. Okay. I know I'm a little bit faster, so but you can just read from the screen. So major pairs. Major pairs, in general, currency pairs can be grouped into major pairs. We have the cross pair and exotic pairs. Major pairs are currency pairs that include the US dollar as either the base currency or counter currency. And one of the other 7 major currencies, we have the euro, the CAD, the GBP, the CHF, the Japanese yen, we have the Australian dollar, the New Zealand dollar. If you are just beginning with trading, you should focus on the major pairs, since they usually offer very low transaction costs and enough liquidity to avoid high slippage. Okay, example of major pairs are Euro USD, GBP USD, and USD CHF. We'll get to know more about them. So these are some of the symbol. We have the GBP USD, Euro USD. GBP USD means British pound, US dollar, which is cable. So these are some of the terms that you need to understand. When you hear somebody say, oh, cable is going up, cable is falling, it simply means GBP USD. We have the Euro USD, also known as the Euro. We have the USD JPY. It means US dollar versus Japanese yen, which is the dollar yen. We have USD CHF, USD dollar, Swiss franc, Swissy, USD card, USD versus card, US dollar, Canada dollar. We call it the dollar Canada. We have the Australian dollar versus US dollar. We have the euro versus British pound, euro versus Japanese yen, euros versus Swiss franc, British pound versus Swiss franc. Okay. Then you can see more in them: the euro yen, the euro Swiss, the euro sterling, and the sterling Swiss. Those are your representatives. You can see the symbol, you can see the trading term, and you see the currency pair. The cross pairs and the exotic pairs. Cross pairs, on the other hand, include any 2 major currencies except the US dollar, that is cross. Unlike major pairs, cross pairs have higher transaction costs, and at times of lower liquidity, traders can face slippage. Cross pairs are also usually more volatile than major pairs. Example of cross pair includes Euro GBP, Euro CHF, and Australian dollar New Zealand. Finally, exotic pairs include exotic currency which are not in the top 10 of the most traded currency, such as the Mexican peso, Turkish lira, or SEK corona. Since those currencies can be extremely volatile, they should be left to be traded by the pros. Please take note. Our advice is to take note of these things because they are very important. Okay, I don't want you guys to pass through long process. Okay. Now we have the cross currency pair. We can see here, like I just said, Euro GBP. We have the Euro CHF, Euro CAD, Euro New Zealand, Euro JPY, CHF JPY, all the JPY, Canada JPY, New Zealand JPY. We have the GBP AUD. All of them are here. You can see them here. Okay. Then popular exotic pairs. These are the exotic pairs: USD Tri, Euro USD ZAR, US Mexico, Singapore SEK. So all these pairs are very volatile. Okay, their spread is high because they are not the most traded pairs. These are exotic pairs. Okay, just for example, let's say we have a USD Naira. It will be an exotic pair. Okay. So exchange rate. The exchange rate of a currency is what all traders follow. The exchange rate is often simply called the price, since it shows the price of the base currency expressed in terms of the counter currency. For example, if the exchange rate of your US dollar is 1.15, this means that 1 euro costs $1.15, or it takes $1.15 to buy 1 euro. A rise in the exchange rate of a currency pair shows that the base currency is appreciating against the counter currency, or that the counter currency is depreciating against the base currency. Similarly, a fall in the exchange rate shows that the base currency is depreciating against the counter currency, or that the counter currency is appreciating against the base currency. Okay, so it's just like I explained to you guys when I show Euro USD. When you are buying, it means that you are selling dollar. When you are selling, it means that you are selling euro. So the difference between the price, that is where you make your profit. That is an exchange. Like if you are traveling to another country, for example, let's say you are traveling to Japan, to China, immediately you take your naira or whatever currency that you have, you are going to exchange that money, and the person who will exchange it for you is going to make profit from the exchange, the difference in the price. Okay, that is already foreign exchange. Okay, now in Forex, we have the bid and the ask price. At any given moment, each currency pair has two exchange rates or prices: the bid price and the ask price. What's the difference between those two? The bid price is the price at which buyers are willing to buy, while the ask price is the price at which sellers are willing to sell. Given its nature, the bid price is always lower than the ask price. Once those two prices meet, either when sellers lower their ask price to meet a buyer's bid price, or when buyers increase their rate they are willing to pay for a currency and meet a seller at ask price, a transaction occurs. So there has to be an agreement. Okay, in the end, buyers buy at the ask price and sellers sell at the bid price. This means that each price plotted on your chart represents the market equilibrium at that point of time. The price at which the majority of market participants are willing to transact. That is what you are going to see on your chart. Okay. Then we have the spread. Each time you enter a trade, you have to pay transaction cost for that trade. That is where brokers make their money, okay? While most brokers don't charge commissions and fees on placing trade. Now, the bid ask price remains the main cost of forex trader. When bulls buy at the ask price, the price at which sellers are willing to sell, their position is immediately in a loss. That equals the bid ask spread. For example, we have the forex broker called ICM. They normally take a commission. So immediately you place one standard loss side on your trade, you will see $7 just disappear. Okay, sorry, I know you guys are beginners, but you will get to understand. So if you are a day trader or a scalper, you need to pay attention to the bid and ask price, since it can eat a large portion of your profit at the end of the day. Swing traders and position traders who have a long-term approach to the trading are less affected by the spread, as they open a smaller numbers of positions and have relatively higher profit targets. Okay, we can see the pips at the point, we have the buying price and the ask price. So you can see the difference here. There's a difference. You can see the two. There is two pip or points. So the smaller the spread, the more liquidity the currency. So Euro USD has a little more of a smaller spread because it's being traded more. Okay. So pip, when forex trader talks about let's say profit loss. Sorry, let me go back to explain something here. The difference between this buying and ask price and the selling price. For example, let's say a buying price may be like 102 naira, and the selling price may likely be, let's say, for 100. So the difference will be 2. That's what it means here, okay? So with pip, when forex traders talk about profit or loss or losses, they usually use the term pips. A pip is a short form of percentage in profit and represent the smallest increment that an exchange rate can move up or down. So the movement of the market between up and down, maybe the market moving 1, 2, 3, all those their movement is called pips. 1 pip equals to the 4th decimal of most currency pairs. For example, if USD is currently trading at 1.1558 and rises to 1.562, that rise would equal to a change of 4 pips. Okay. However, some currency pairs have their pips located at the 2nd decimal place. You get to learn all this more. Okay. So pipette, a pipette is the 4th decimal place of most currency pairs. So what's a pipette mean? It's called a pipette. It means, for example, let's say you have 1 pip. 1 pip is equal to 10 pipettes. Okay. So when somebody say that, let's say I made 10 pip, that 10 pip is equal to 10 pipette. It's like me explaining that 100 kobo make 1 naira or 100 cents make $1. Okay. So most traders don't follow movement in pipettes, even though some brokers use them in their trading platform. A lot of traders don't know what is called pipette. They just know pip. Okay. But you can see here, which is the different people point. Oh, I think we have few minutes on this. We have the leverage. The first market is open around the clock and offer trader to profit not only on rising prices but also on falling ones. However, there's another reason why a large number of traders feel attracted. Okay, you guys can read from the screen here. I think we have lesser time, so I will go a bit faster. We have the margin when trading on leverage. Your broker will allocate a portion. So if broker do not give you a margin, you will not be able to enter more trade. Okay, so the margin helps you to able to enter a position. Okay, which is also like leverage, help you to take more position. But the margin, the way if you open a position of 100,000, let's say 100,000 positions, start using one ratio, one leverage, your margin will cost to 1,000. Okay, you know the leverage is to help you to be able to access more funds. So 1:1 means that, for example, $1 is equal to like $100. That's the leverage I'm giving to you. So it will also help your margin able to increase when you are taking a trade. While the loss size, like I explained, the loss size is the position size you take on the market to determine the size of your profit and losses. For example, if you are taking if you choose $1 as a one loss size, for instance, if the market move up one, let's say you are buying, if it moves 1 times up, it means you are in profit of $1. If it moves back minus $1, that's what you're going to get. So loss size is very key when you're taking the trade according to your equity. If you don't use the right loss size in your account, you will blow up your account. So our support and resistance, these are some of the things that you will learn. So support and resistance are one of the most important concepts in technical analysis. Technical traders analyze only price moves and they believe that the price reflects available fundamental information. Okay, we have the support also known as the silly. We have the resistance known as silly. We have the support known as the floor. Okay, so we see this. We can look at it here. Look at the image. We have the resistance, the support. Then also a resistance can also become a support as well. Also a support can also become a resistance. Okay. Now, Forex market analysis. We have 3 types of Forex market analysis. We have the technical analysis, the fundamental analysis, the sentiment analysis. There are always been a constant debate as to which analysis is better. But to tell you the truth, you need to know all the 3 so that it can be able to help you in your technical analysis as well. Okay. Now I'm going to show you guys something quickly. Let me go to my chart. Sorry. Okay, so this is a platform. This is the Forex platform for those of you who are new here. When you are new in trading, you need to register with a broker. Okay, so the broker, there are so many brokers which we will teach you guys how to be able to select a broker. Then you have file. This is a platform. You have file. For example, you can come here, log into trade account. Then you click on the account. You put on your info. So this is a real account anyway. This is a real account. Then you can choose here how the view, the toolbars, all those things. So how your time frame here, 30 minutes time frame. It will load all these, how the auto trade. For how to set all these candlestick, I'm going to teach you guys. But I think because of time, I want to make it short so I don't pack too much things for you guys. Okay, all these are candlestick. So let's draw support and resistance. Let me just show you guys something quickly. So this can be like a resistance. It can be a support. So how to do all these things is what you guys will learn. So this is just like a basic introduction for you guys to know how Forex work. Okay. Then you can see your balances here. You can see imbalance. These are some of the trade that is running right now. These are live trade. And you can see the account balance here. And you can see history. You see deposits of 8,787. And you can see withdrawal of 76,600. You can see the total profit that is made so far, 82,374.44. Okay. So this is just a trade platform where you come and do your analysis that we just talk about. Those technical analysis here. These are the charts. You can see history. So it goes back to history, know what is happening. So all this movement here, there's money in the market that is moving. So buyers and sellers are the one moving the market at this position. Okay. I think I have 5 minutes. I will just give you guys to just ask you a question. Maybe we can schedule for another time for me to teach you guys more of that thing. Hello, can you guys hear me?
Yes. Yes.
Yeah, do you have any question? Do you have anything to say so far? I think we have lesser time. This is just a short introduction, but at least you guys I believe you guys learned something so far.
Yes.
Do you have any questions? Any question? Love.